Let's take the conversation forward with Mark Matthews, Head of Investment Research with Julius Baer. Mark, I guess depending on whom you are asking, you will get a different answer. If you own India, this is a great time to own emerging markets. If you own other markets like Turkey, or for that matter, Indonesia, this is a horrible and a terrible time.
Well, it depends on your time period. So from the beginning of the year until now, it would be a terrible time to be an investor in Turkey or Indonesia. But actually, the Turkish lira and the Argentine peso, which were the two eyes of the storm, if you will, believe it or not, they've both rallied quite strongly over the last week. Perhaps the storm is just moving on to a different place, but I think there are opportunities in some of the ones that have become, very, very bombed out. Argentina would be top on that list because I think they've put forward a very cogent IMF-approved recovery package. They'll go into recession for sure and not come out of it until around sometime, I would say around this time next year, but their bonds are yielding such high rates that I think it makes them look attractive.
No, absolutely. But the question on everybody's minds, Mark, is that how should one look at the currency situation? Is it more internal, where a lot of emerging markets are grappling with macro hurdles, or is it more competitive and pegged against the dollar?
I'd say there are two primary dynamics. The first dynamic is the very strong U.S. economy, which we saw further evidence of on Friday with the payrolls and the wage growth. So the American labor market is looking very, very tight. Unemployment down to 3.9%. It almost never gets there. And intuitively, you should see wages rising more and therefore inflation rising more on the back of that. So Jerome Powell has to walk a fine line because on the one hand, if he pauses and he doesn't raise interest rates, there's a chance that the U.S. economy will overheat. But if he does raise interest rates, there's a chance that the yield curve inverts, which historically has been a predictor of recessions, and that we get a further emerging market crisis. So I don't know which one it's going to be. Now, the second dynamic impacting this whole asset class is what's going on in China, and so the trade war with the United States. And that still doesn't look good at all. You might have seen that President Trump is now threatening to tax all of the Chinese imports into the United States. And he sent out a tweet on Saturday urging Apple to build factories in the United States. I don't think the Chinese can do much about this right now. He's simply not interested in negotiating. His trade negotiators are about as hawkish toward China as you could possibly find of people. Mr. Navarro and Mr. Leitzeiger. So I think the Chinese are just patiently waiting for the U.S. midterm elections, hoping, and I think they could be right, that the Democrats get the House of Representatives, in which case it would make it much harder for these China hawks to push through such punitive tariffs.
Well, yeah, indeed. In fact, if the tweet is anything to go by, it seems like that's what spooked the equity markets as well. The fact that Trump has issued a very stern warning to Apple, has asked the iPhone maker to make the products in America if it wants to avoid tariffs set to be placed on imports from China. So, Mark, you're building up actually a very interesting scenario in the 6 months. You don't believe then that these trade war fears could be escalated enough, right? And you think maybe that the worst is already in the price?
I think that sometimes politics are very important, and in this case they are. So if we have a so-called red wave in the midterm elections in the United States, that means that the Republicans sweep both the House of Representatives and the Senate, then I think that would be a huge vote in favor and in confidence of Donald Trump, and he would have the confidence to remain very, very hard on China. And that could possibly push China into a recession, but it would also, I think, mean a lot of inflation in the United States, because imagine if all of the Chinese goods imported to the United States were facing a 10 or 25% tax. that would cause a big spike in inflation and probably slow down consumption. So that is I think the worst case scenario. But thankfully, the polls, and I have to admit, the polls haven't always been right, with Brexit and Donald Trump himself. But the polls are telling us now that the Democrats are going to get the House of Representatives. I think that'll make Trump feel less confident and put the Chinese in a better position of making a deal with him.
What will derail equity markets? Oil, interest rates, Trump, or something which we don't know today?
Well, one thing we haven't talked about is what's going on in the technology sector. And the social media companies, if you look, there's a social media index in the United States. They're sitting right on this support level, this upward support line they've been on for the last 2 years, and their 100-week moving average. And Facebook is exactly the same if you look at it technically, and it's the biggest of them. So that they've actually started underperforming the broader market, these tech stocks. And that's sort of important in the sense that they were the leaders, of course, of the huge bull market since 2015. Now, the reason is that they've come under a lot of regulatory scrutiny again, and both Twitter and Facebook sent their CEO and COO, respectively, to testify before Congress last week. And I think they gave as good answers as they could, but it's very clear that the Democrats feel that these companies have not stopped hate speech and have not stopped Russian interference into the elections. And then on the other side, the Republicans think that the liberal-minded employees of these companies are kind of messing around with their algorithms, so conservative thought isn't appearing on them. But Bernie Sanders is also talking about putting a tax on companies whose employees get social benefits, because he thinks if you're not paying them enough, even so that they have to go and get some kind of social support, that that's very unfair for these companies that are run by the richest people in the world. So anyway, what I mean by all that is that you never know where the next thing is going to come from. But I think the technology stocks are certainly ones to watch because they're at key levels now.
If the most crowded trade in the world reverses, which is over ownership towards the so-called internet FANG or these technology companies, what will happen to ETFs? What will happen to some of the fund managers who currently are running a very overweight position in the Facebooks, Alphabets, and the Apples of the world?
Yes, well, either they would put it in another sector or they would put it in cash. I just don't know the answer. It probably depends on the other things that are going on in the world right now, interest rate policies, trade war, all of these things. We've got a lot of volatility, I think, between now and November. But the overarching thing that I should also mention in the background is that the world economy is growing at a very healthy clip. And even if there is some mild deceleration that we've been experiencing since the summer, you can see that showing up in PMIs. The fact is that the world economy will probably be growing at about, 3.8 to 4% this year, which is just really, really strong. So that is supportive of earnings. And even though China is going through such a hard time now, I want to point out that first half earnings for Chinese companies were still up 17% year on year. And of course, Indian companies' results are up over 20%. So ultimately, what moves share prices is cash flow, and the cash flow is good. And it's just a delicate balance between that and interest rates. And I guess that's what the market's grappling with right now.
At a time like this, Mark, how insulated could India be? Because irrespective of it being the best emerging market on a year-to-date terms, we are also grappling with our own problems. Like we were just mentioning, you've got the rupee, you've got crude, you've got its impact on current account deficit. And for us as well, there is that big overhang on the impending general elections in 2019.
So the rupee and the oil price are linked. And if the oil price goes to 90, I think that's going to be very bad news for the rupee. And will the oil price go to 90? I don't really see why it should, frankly. I think Saudi wants to keep it somewhere between call it $70 to $80. But once you get over 80, there's so many marginal suppliers who start to break even and who start producing oil at that price. So that would be one thing. The other thing is the politics. A few months ago, it was looking shakier, but I feel now there's more and more more and more people are coming around to thinking that the BJP and its allies will get another vote in. They'll be reelected next year, and so on balance, I think it's a good story. The only problem with India that might keep people away is the possibility of more currency downside if the Federal Reserve continues to raise interest rates.
So, Mark, a year from now, or I would say year is a long time. Let's talk about rest of 2019. Should one fasten their seatbelts for a lot of volatility because you don't know which way the next salvo would be fired, whether it is from emerging markets or whether it is from the Republican administration? Or can one take a rather safe and a benign view of financial markets and work with the assumption that from here to December you will get a better exit?
I usually like to have a strong opinion, but when I don't have one, I don't dare try to make one up. So the honest answer is I don't know. I feel like there are still pros out there, like the strong global GDP growth, like the strong earnings growth coming through in the United States and in China and India. Europe's earnings growth is about 10%, which is not stellar, but certainly decent. So you've got the earnings growth on the one hand, then you've got the politics in the middle, which I think will, clearly be volatile going forward. We've only been talking about America, but you've got the Swedish election, for example, and the Italian budget coming up in September, potentially a lot of fireworks in Europe. And then looking forward, we have some elections here in Asia next year, not the least of which is India. All those things are going on. And then on the most bearish camp, there is this idea that interest rates may have to go up more. And if that happens, then the dollar would probably follow them up, and that would keep people away from the emerging markets. So, putting all those things together, I find it very difficult to give you a lot of conviction. I guess all I would say is that history shows it's best to be invested and not be in cash. And so if you just buy and hold good quality companies, and you'll come out much better than holding cash if you're patient and hold over the years.
That indeed is the case, Mark. But how do you react to the rhetoric which is building around this bull market having extended itself for almost a decade, and that 2019 could bring to the fore all the challenges, macro and micro wise? It could come out of emerging markets. It could come out of the U.S. The bubble could burst in the debt markets. Largely building the opinion that one needs to be a little more circumspect about the upside potential for the markets from here and be a bit more prepared for a turnaround, or not in a positive sense, but really a move into the negative.
I don't think the emerging markets are big enough to take down the S&P. You've got to remember the S&P, the U.S. stock market, is a $30 trillion market. The largest emerging market is Shanghai at about 5. India's about 1 or maybe less. So I don't think they are enough to really bring down this juggernaut, which is the S&P. But the S&P can be brought down by a recession in the U.S. That's one thing. So it's true. We're in over our 9.5 years now of an economic recovery in the United States. They usually don't last that long. But the thing is, the Obama administration, as well-meaning as it was on the social side, really did put in a lot of rules and regulations that slowed down that rate of growth. And so now we've got some catch-up from there. Now, I would say one caveat with the Democrats winning the House of Representatives in November, if they do that, also, if you look at the quality, if I could put it that way, of the Democrats who are coming to the top of the leadership now, they're much more left-leaning than Hillary Clinton was. And they're realizing, I think, that the way to get elected is by espousing a very left-wing kind of Bernie Sanders type view. So that could mean, more regulation in the big tech giants. It could mean just higher taxes in general. tax rates, corporate tax rates are relative to employee compensation are at extremely low levels. Corporate profitability is extremely high levels relative to employee compensation. So those are the kind of things that I would be looking at a little bit more. Basically this impending midterm election, which I think is very important, and then the increased scrutiny of the technology sector.
Okay, Mark, lovely having you this morning. Thanks very much for taking out the time to speak with us. I really appreciate the insights you shared.